Hello, hello, hello. Hi, everyone. How's everyone doing? Zorya, how are you?
I'm great. How are you?
I'm great. So we are on the flip side. Every Monday, we do on the flip side, and the first Monday of every month, we'll do mindset, and then afterwards, we do different topics on real estate. And so today we have Zorya Belanger on, and she is going to be talking to us about the Edmonton market and including CMHC. So I think we're all excited because I know the Edmonton market is booming right now. So I'd love to hear why it is, because there's always, lots of people are going down there. So it's good to understand why these things are happening, especially when we're having these rate increases, right?
Yeah, exactly. So, yeah, thanks so much for having me on your show.
Awesome. And so let's get started. Just give people a little bit of background on you, your experience like that in the Edmonton market, whatever you'd like to share about real estate investing, feel free to share.
Sure. Well, my husband and I started investing, like we bought our first condo in Edmonton in 2010, and we've been buying property like specifically for like investing purposes over 9 years now, and all in Edmonton and area. We were also like born and raised here, so we know the city really well. And it worked out that when we started investing, it was a really good time to buy here. And now we're kind of at those times again, which is it's just nice because it's been like 6 years of being in a recession. And
Mhm.
yeah, I'm a former engineer, but I've been doing real estate now full time for the last 5.5 years. And I've been focusing on for the last little while, since I guess last 5 years since I've been doing this full time, on small multifamily in Edmonton and specifically new builds. So and yeah, CMHC. When I wanted to say, like, when we're talking about CMHC, we're definitely talking about commercial financing, because some people might, that's totally different on residential and commercial. Yeah,
That's
so I've been now done, I'm working on my
multi.
third CMHC MLI Select loan. I guess the fourth CMHC loan, but the third MLI Select. And yeah, I have about 10 million in assets under management. We're at 26 doors, and six more are going to be coming. We're going to have soon. We're just waiting for them to be finished being built. But then, yeah, we'll have 32 doors in Edmonton.
Awesome. Thanks for sharing. So I'd love to know with the viewers, who is interested in investing in Edmonton? We'd love to see who is interested. Or even if you're living in Edmonton, it's always great to know who is there and who wants to go there, because you guys can always all connect together and help each other out, because feel like we're getting into the times where now it's like really like collaborations, partnerships is becoming a lot more bigger and more important these days.
Yeah, absolutely. Especially if you're going to get into multifamily, right? It's a team sport.
It definitely is a team sport. So tell us, like, so what do you love about the Edmonton market? Why are interest rates increasing and not impacting the Edmonton market so much? Or like, what changes have you been seeing?
Yeah, well, I wouldn't say that's not impacting the market, because yeah, it's definitely going to have an impact here. But I think the difference between here and Ontario is just in the spring, in the last couple of years, we didn't have as big of a rise in prices as we saw in Ontario. So that's why we haven't seen as much of a decrease in prices. Like, I think it's almost stayed the same. There's like a 1% decrease or something
Mhm.
since um, yeah. So I think that's why, yeah, we're not seeing those big decreases, which is good. The other really good thing that's happening is that rents are finally going up, and they started last year, but now we're like really optimistic about the next year and the next 5 years, because like we had really high rents in 2014, and then they just kind of dropped in 2015, because that's kind of the downside of not having rent control. They can go up, but they can also go down. Um, and so we've kind of been at bottomed out rents for the last like 6 years. And that's why I've been comfortable buying though in those times, because I was like, well, rents can't really go any lower than that. Um, And yeah, so we're finally seeing those rents go up. And when rents go up, like you can increase them by $50, $100, $150. And
Mhm.
like you just have to do it once a year, but there's really no limit. Um, you
Yeah,
can just
that makes
boost them
sense.
up to market.
And so you were talking about that you see like the next 5 years being good in the Edmonton market. What specifically are you seeing that gives you that confidence that Edmonton is going to continue doing well?
Yeah. Well, you always look at kind of the fundamentals, like where are people moving to, the economy, and everything is looking good for Alberta. Like there's a lot of in-migration. There's a lot of um, immigration too from like outside of the country. And like when people look to where they want to live in Canada, they're going to go to where it's affordable. And Edmonton and Calgary are still very affordable and very attractive. So we're seeing a great influx of people, vacancies going down, but not as, I guess, as not as much construction as we need. So that's going to put like pressure on those rents.
Mm-hmm.
And
Yeah.
then, yeah, the economy, yeah, we're like, we were coming out of like our recession 2019 and then COVID hit. So now we're kind of seeing that recovery happen. And, I think it's definitely a myth that we are all oil and gas. We're actually like just as diversified as any other province. And yeah, I think Edmonton specifically is continuing to focus on other areas, um, you know, clean energy and healthcare, education, government are also really big things here, and agriculture. So we're seeing, yeah, like there's going to be good GDP, positive GDP growth this year.
That's great. And yeah, actually, that's interesting you say that. Clean energy, I feel like is going to start becoming even bigger just worldwide. Like the importance of it, I think is growing so much that is definitely a great like positive thing to have over there because that exactly you said, like it's just another thing that is going to help it boom even more or just be more stable, if anything, to help stabilize it a bit too.
Yeah, we won't see like the big up and downs if oil prices go down up. And I think we have like, it just makes sense for Alberta to be that location where we can really like do the carbon capture and hydrogen and that kind of thing, because we have the people that could work in those industries.
And so, what got you into the MLI? Or actually, tell everyone what it is exactly. Just like an overview of CMHC and specifically related to multi units.
Yeah. Yeah. So CMHC, what I've been doing is the commercial side, which is different than CMHC's roles on the residential side. Like on the residential side, like they're basically helping people if you're buying a personal, your primary residence. On the commercial side, CMHC's mandate is basically to create more affordable housing and to help finance those loans. And specifically on like on the new construction side, so there's the MLI Select program that came out last March, and that was specifically for like new construction that works the best. And I would say that, yeah, and since I was doing new construction, it worked out really well. And also, I guess what CMHC's role in on the commercial side. So the CMHC is not a lender; it's a government organization. Okay? So they are insuring. It's an insurance that you're getting, but it's insuring the lender, not you. But because CMHC is insuring the lender, then you can get much better rates, much better terms, and so it makes a lot of sense when you have a nice stabilized property, which is basically what we're doing when we're buying brand new properties. There's not much value add or rent increasing or improvements that we're doing. So it works really well for the new construction. And so the MLI Select, they do have a version for if you're buying existing property or refinancing, and then they have it's slightly different if you're doing new construction. And I've been hearing like people that are doing existing property, it doesn't make as much sense because the rules are a little bit harder to follow, I guess. But basically it's easier if I had a chart to show, but there's different ways you can get points. You can get points through affordability, through energy efficiency, and accessibility. And the more points you get, the better terms you get. And so we all have been focusing on affordability because in Edmonton and in Alberta, it's really easy to meet those criteria because it's already affordable here. So we don't have to like reduce our rent in order to qualify. Like the rent just has to be below $16.50, and that could be for a 1-bedroom. So almost I don't know any 1-bedrooms that are more than that. So so it's really easy to qualify through that. Although I do know investors here who are doing like infill, and they are focusing on the energy efficiency too. And there's lots of like great reasons to do that. Like you can definitely save on utilities if you have an energy efficient building. Yeah. So, but yeah, on the affordability side, which is what I've done for 2, now going on 3 loans. For the new construction, you only have to have 25% of your units considered affordable. And you're basically putting rent control on 25% of your units. And in Alberta, so like I said, you have to, CMHC has a chart. It basically says it's based on like what the median renters make in income, so if it's like here in Alberta, and Calgary, I think is the best place to do this. They have the highest, I think it's on like $1,700 that is considered affordable.
Oh, so even those numbers actually change by the city too.
It depends on the city. So you can see I can even send you the link so you can share it with everybody. But you have to look at your city because you look at the median renter's income in that city. And then you take 30% of that. So in Edmonton, it's 66,000 is the average person makes. And so 30% of that, and then you divide that by a monthly, that's $16.50. So basically I have to have my rent start at $16.50, but then after that, so there's a misconception that you have to always like keep your rents below that you can increase them as much as possible, but then they have to just stay below that. And that's not the case. That's the starting point has to be below that. And then every year you can only increase rent by inflation. So whatever CPI is, but that's in Alberta. If you were doing this in Ontario, then you'd have to follow the usual rent control, like whatever percent you're allowed to increase that year.
Oh, okay. So for example, for this year, what was the inflation was like what, 7 or 8? So you could actually increase to 7 or 8%.
Yeah, exactly. So that's quite
nice.
a lot.
Better than where we are in Ontario.
Yeah, that's why like I don't really feel like handcuffed by it at all. Like if I can still increase rent by 6% each year, then that's fine with me.
Yeah, exactly. And so what even got you knowing about CMHC for multi-units, or just getting involved and wanting to use it? Because I think not very many people actually know about CMHC. Like you said, for the commercial side, we're so used to hearing it for first-time home buyers mainly, I feel like.
Yeah.
But you don't really ever hear it on the multi-unit. So how did you come up to it and learn about it and get involved in it?
Well, it was when I first started getting into multifamily. I did a training with Pierre Paul Turgeon, and he has like 160 units in Edmonton, and he used to work at CMHC as an underwriter, and so he knew that strategy or that type of lending very well. But I think anybody in multifamily, like they know there's like 2 different types. There's the conventional, and then there's the CMHC insured loans. And there's like the 2 routes that you go. And so conventional, you're typically putting like 25, maybe 30% down. There's pros and cons to both, but yeah, CMHC really helps that. You can, the regular program, which still exists, you can put up to as little as 15% down. But it's best, like I said, like with a nice stabilized property. So it's good if you're gonna, even if you have an existing property that you're gonna renovate, like get a bridge loan while you're doing that, then once it's stabilized and you have your rents high, then you go get the CMHC, because you'll get like a 5-year fixed interest rate, and you can get what really makes sense now. It used to be a 40-year amortization. Well, it is still for the regular program. With the MLI Select, it's a 50-year amortization.
And the difference between the two is just that the MLI, you have a point system that can help you get to that only 5% down payment. Is that right?
Yeah, exactly. So if you have 100 points, you can get up to 5% down and a 50-year amortization, and the debt service ratio is 1.1. So all of those things, they help a lot in increasing your cash flow, because your mortgage payment is going to go down. But the downside is you are a lot highly leveraged. So that's again why it makes more sense to do on a brand new property. You don't have as much risk in those like rents dropping and your building not being worth as much, and you being like underwater in your mortgage. But yeah, you get all these points, and so you get when you get the best terms.
Oh, interesting. And so when you, do you want to talk about one of the projects that you've done, and just to give us an idea of how that works with the multi-units and like that, like even time frame wise, like did you have problems with delays? I've heard other people do have problems with delays with CMHC.
For sure. It is definitely a longer process. And I think right now the timelines are about 3 months. So yeah, that can be challenging if you're trying to buy something, right? You don't have that kind of time. Again, why it works for new construction, because I have like at least a year while it's being built to get my financing in place. So my very first property, I just got the regular CMHC program because the MLI didn't exist. I did experience delays with that one, but that was because of COVID. So that was kind of unusual circumstance. And so yeah, when the MLI Select came out, so that was last year. So beginning of 2022, we got possession of our 8-plex in February. And we had to close with like a bridge loan because,
because of the delays.
Well, not because of the delays, because okay, so another big difference between the CMHC regular program and the MLI Select is that with the regular program, you need to have your building fully leased. They want to see all the leases and how much rent you're getting. With the MLI Select, with the new construction, you can find a vacant building. And this is huge because if you are building a new construction building, like it is really stressful to try and lease the whole building before you take possession so that you can get your loan. So what we've had to do in the past is get bridge financing. So we close with bridge financing, and then we get it all leased up, and then we had to refinance into a CMHC loan. And when you do commercial financing, all the closing costs and lawyer fees, everything is so much more expensive. So having to do that twice, like it cost us about $40,000 just to have to refinance it.
Oh wow!
But yeah, this last 6-plex that I just took possession of, I could go straight into the CMHC loan.
Sorry, can you say that again? What were you saying?
Like this last 6-plex that I got possession of, I could go straight into the CMHC loan. I didn't have to get bridge financing, even though I still had some leases signed, which was nice. But even if I had it completely vacant, I would have been able to close with the CMHC loan.
And that's because of the MLI?
That's specifically for the MLI Select program. They don't have I forgot what it's called, but they don't have that requirement.
And so actually, so is it just MLI and then the generic one? Are these the only two, or are there other ones?
I think CMHC has other programs, like they have different construction financing programs, but I'm just not as familiar with them. And they could be like, yeah, but not for multifamily.
Oh, but just for the multifamily. I mean, for multifamily, it's just those two?
Those are the main ones, yeah. I don't really hear anyone talking about anything else, but like if you're in development or construction, they do have different programs that you could use for that, but I haven't been doing that. Like our builds, we basically don't need the financing until we take possession. So I'm not dealing with the construction financing side of things.
Makes sense. And so the one that you were saying where you had to do the bridge loan, that was because you weren't using the MLI Select, then you're using
Yeah.
the other one, and was that like that was the first time you had done it, or did something change from the first one to this one?
Well, just the MLI Select program came out like just before. We didn't have that option.
Okay, so all the other ones have been with the MLI Select. It was just the very first one that was the generic one, or what is it called? Yeah.
Oh, it's just, yeah, I don't know. It's just
The
a regular
regular
program.
Yeah. Okay, got you. Okay, so that makes sense, and that makes sense why I guess the MLI. So it is a lot more. Can other people use the MLI Select, as in the sense of, does it have to be new developments, new developed ones, or no?
No, like if you're buying existing property or you're refinancing something that you own already, you can definitely get the MLI Select product. It's just that the criteria are a bit different. So on the affordability side, instead of having 25% of your units rent controlled, you have to have 80% rent controlled. That's a huge difference.
That is a huge difference.
Yeah.
Do you know why, by any chance, why they make such a difference like that?
I think because they're trying to incentivize new construction. Like the whole point of this program is to help affordability, to get people to be building more housing to solve the housing crisis.
Yeah.
So I think that's why the terms and like the benefits of the new construction are a little bit better, just to incentivize that.
Yeah. More like a lot better. That's quite the
It's
difference.
a lot better. Yeah. So yeah, it's 80%. So that's why a lot of people who buy existing property have not been going with MLI Select. They just feel really constrained by it, especially since typically when you're buying an older property, like you're going with a value add strategy, and you're going to be improving your property, and you want to be able to increase the rents, and you want to be restricted by how much you can increase them. So I haven't really been hearing of it as much on the existing. But yeah, that's the biggest difference. I think the DCR is a bit different as well. But as far as getting the 95% loan to value and 50-year amortization, that still applies. It's just there's different criteria to get to those 100 points.
Okay. So yeah, it changes. And just to let everyone know, if you're interested, we are having our networking event, and Zorya will be a guest, and she'll be going in a lot more detail on CMHC and just helping us out to understand. So if you're interested in multi-units, then you want to join the networking event, because I'm assuming you'll probably go through examples too and everything. Like you'll just be telling us everything, going really into the nitty-gritty. Right now, we're really going over the surface just to talk about it, but just to give you guys an idea. So if you guys are interested, get into my bio and click on the link, and you'll be able to register for the next networking event. Next month.
I'll have a presentation, and I'll actually like show the chart and then kind of explain it, and it'll make a lot more sense.
No, this is just an overview. But I just wanted to plug that in because right now, I think right now is the time where, like you were saying, multi-units in general are already a very collaborative type of real estate strategy. You want to go in with a team, and CMHC does get used a lot by different, by a majority of the people, I feel like always use CMHC for the multi-units anyways. But that being said, curious, because you're gonna be having one close this year. You have one closing?
I have one closing in May, they're saying. And I wanted to talk about that one because it's been really interesting. I wasn't going to go with CMHC for that one. And
I was actually gonna ask you if the interest rates, because like you said, it's like a 5-year term. Curious on your opinion on
Yeah.
like what you're planning to do with like that, these interest rate hikes and everything going on? Because like that is very normal in multi-units. You don't do variable. That doesn't really exist. It's always
No.
fixed. So
Yeah.
curious to hear what you have to say about it, what you've seen so far.
Yeah. So like my experience so far is like that this MLI Select program has really saved our investors' returns. Like we would have had a lot less cash flow, a lot lower returns if we weren't able to do this MLI Select. So so like the one that we closed on last November, because we like initially was planning our investors were going to put 15% down, but since we ended up getting 94 loan to value, so only 6% down. So by suddenly like cutting their investment in half, really boosts the ROI, because the interest rate is definitely cutting into what we expected like a year ago when we first started this project. So that kind of saved us. And then so this one that we're taking position this year, it's a little bit, I guess, different than a traditional multifamily, because it actually is 3 residential properties. It's like 3 duplexes, in total 6 units. So the plan was initially almost 2 years ago when we started this project, the plan was to get residential financing, and that's what we get. We got pre-approved for 3 residential mortgages. But now I'm looking at our options, and this MLI Select makes way more sense. Because with a residential, you have to put 20% down. With MLI Select, we can put 5% down. That's a huge difference. The other thing with interest rates, like on the residential side, I'm looking at rates around 6%, but on commercial, CMHC rates, it's actually 4.5. Like it's much lower.
That's not bad at all, actually. Yeah,
That's a huge
that does
difference.
make it seem, yeah, it does make it seem worth it, and like feel okay to do like a 5-year term with that. Because sometimes you look at like, oh, 6%, let's say, and you're doing a 5-year fix. I was like curious on your thoughts, but if it's something like that, then you're just like, might as well go through it. And then you just blow over this like interest stuff. And by the time you do, it's probably going to be back to normal interest rates again.
Exactly. Like, and I was thinking about like, do we go variable and go residential variable and kind of like, just deal with the high interest rates, and then like we'll get the advantage of when it goes lower, but we don't know when that's going to be. And if you're already starting at like 1.5% higher, like it's going to have to come down quite a bit for it to get to 4.5. So yeah, because the commercial rates, they are based on the bond yields, and they're not exactly the same as like the regular Bank of Canada rates. So when the Bank of Canada rate went up, I know this because we were taking possession of our last 6plex, the Bank of Canada just announced like another rate hike. And that same week, the bond yields went down. So like it actually, and then we locked in. So it was like, yeah, we just really locked up, but they don't like correlate exactly. Like, yeah, Bank of Canada went up and bond yield went down by 0.5%. So,
oh, that's good. That's good to see, because I know on the residential side, it was actually quite different, because same thing, they talk about the bond yields for the fixed rates for residential, but it actually didn't go down. And the lenders on the residential side actually maintained it and probably increased it. Like they went with the Bank of Canada interest rate hikes instead of the bond yield. So that's interesting to note that on the commercial side, they are actually still following which I feel like kind of makes sense that they would follow it. Because like that on the residential side, a lot of people who buy are just homeowners. So it's like more emotional buying, where probably that really like scares lenders, like A and B lenders. And they probably decided with the fixed rate, you know what, let's just kind of go a little bit more with this, like continue going up on the fixed rate, compared to on the commercial side, where it's a lot more business oriented. We're thinking about the business side of things. And so they probably have less worries on that, they won't be able to pay, make the payments, because it's more of a seen in a business aspect compared to like on the residential homeowner side, where it's more of an emotional purchase. And And I mean, it's always like, you know, one person vacant. Like if you lose your job is very different to like if you like maybe two units lose their jobs and you still have the other ones kind of hold you over or something.
Yeah. Yeah, that probably does play into effect a little bit. The lenders, I think it just also depends on just the rates that they use, like the commercial lenders, what rate they use when they're like borrowing that money from somewhere. Like I don't know the details about that, but
No,
it's
because
just
they're
it's a
supposed to with
totally
a
different
fixed.
sandbox, right? Of how
Yeah.
like the lending works on the commercial side. So yeah,
Yeah, exactly. But well, what I've heard is that even fixed rates on the residential side are supposed to follow the bond yields, but they were saying like that it's
they're
been so
higher.
strange, yeah, that they haven't been following. And a lot of people are thinking probably because the banks are worried about a lot of people losing their houses, so they just want to keep the interest rate high so that people who are buying right now can actually afford to buy, and you know, and it's not just because of a lower interest rate on the fixed side.
Yeah.
So yeah, that's very interesting. That's good to
Hmm.
know. And because it's sometimes you look and you're just like, how do I make it work even like on the multi-unit side, you know? And it's good to
Yeah,
hear
how do you make it
that.
work? Yeah, it's what made making our project like work still work in these like high interest rate environments. And
Yeah.
if someone is wondering like what a commercial rate might be, like if you just look up the Canada 5-year government bond yield, like it fluctuates, like even during the day it fluctuates. And when you're locking into a commercial loan, like it literally depends like which minute you're locking in. It
Oh, really?
sucks sometimes. Like I was like a little late like getting back to my broker, and like I like it cost me $1,000. Like okay,
Oh
well,
no.
but it
And
just
what about
changes so fast. But I wanted to say, yeah, so you go to the 5-year government bond yield, but that's not going to be the interest rate, that's the bond yield. And then you want to add like 1.25% or 1.5 to that, and then that will be about what you can expect with a CMHC loan.
interest? And is it like the residential side where, you know, for example, you can kind of lock it in for a month? Like, are you able to like lock in something for like a month, or it's just like once it's ready to do the more you lock in at that time?
Well, yeah, my experience used to be that basically what the day that your loan funds, like whatever day you end up closing on, that's the rate, whatever it is that day. But
Because you can't even like pre-approve
you
like a month
can't.
before, like, okay, it's gonna be this and no, like it's basically when it closes, and
That's
that's
like typically what it is. But some lenders will allow you to lock in a little bit earlier. Um, so yeah, for my last two, I've gone with People's Trust, and they've allowed us. Can't remember how long in advance, but well, we were able to lock it in, which was huge. So we were kind of watching it and then trying to time it
time
a
it a
little bit,
bit.
like
Yeah.
working with my broker because he kind of and so that was good. So we were able to like lock it in
That's very interesting.
advance.
I definitely did not know that. And I feel like it's like a little bit of mini gambling. Okay, let's wait till tomorrow, see what happens.
Yeah. Yeah, or is it like no, it's like lock in now, it's gonna go up.
Yeah.
Um,
That's funny. I definitely didn't know that that worked that way. That's something new that I learned. That's funny.
yeah, and I don't know all the details of, let's talk to a mortgage broker, like which lenders allow you to do that.
Mhm.
But it's not like residential where you can like lock in like 3 months beforehand. It's
Mhm.
definitely not that far in advance.
Yeah, yeah. I don't even think you can do that anymore now. Probably only allow a month now with how just crazy the
Yeah,
market is.
probably.
That's so interesting. Any other final things that you would like to tell that I haven't covered or asked that you wanted to share today?
Oh, I think we covered like the main points. I wanted to share that. Yeah, my last property.
And so, do you
Yeah.
want to then tell the viewers? So,
Mm.
what are you going to be talking about at the networking event? Do you want to just give a little overview to let people know what you'll be sharing with us?
Yeah, so it's going to be more detail on, so I'm going to go a bit more about like myself and my experience with CMHC and multifamily. I'm gonna just go over a little bit more detail, like what we talked about today, but I'll like present the chart and kind of tell you how it works and you know, how you can, and we can talk a little bit more about energy efficiency and accessibility, how to get points through that. And you can actually get a combination of some affordability points, some energy efficiency, because people in Ontario, like affordability probably doesn't work there, but I hear a lot more people go with energy efficiency. So we'll talk about all those different things, talk about existing versus new construction. And yeah, I'll give you like a more detailed case study, and I will go through the numbers of a property, of like maybe going, you know, the regular CMHC versus MLI Select, kind of the pros and cons of them.
Yeah, that'd be great. Awesome. Thanks for sharing that. So if you guys are interested in getting to know the nitty-gritties of CMHC, then you have to come to my networking event. And then afterwards, we'll all get to network. And if you guys have the one-year memberships, you'll definitely also get partnered up with Zorya. So while you're there, if you do have questions and you do have that one-year membership, then you'll also be definitely matched up, and you'll be able to ask that one or two burning questions that you do have, or any other details that you want to know to help you out, either in the Edmonton market or related to CMHC.
I have one last thing that I thought of, because this comes up as like another misconception. So even though you can only have to put 5% down, don't forget about closing costs. I have, like, when this first came out, I had so many people messaging me like, oh, I have like this amount of money for the down payment. Like, does that mean I can qualify for this much? Like, yeah, but closing costs are going to be another 5%. So if you're kind of budgeting like how much money you have, like you're going to at least need 5% for closing costs. So don't forget about that.
That's a good point. That's very good that you say that, actually, because I feel like even in regular homes, for some reason, people think to forget about that. And like you said, with CMHC, you're actually adding on more costs because you are paying that insurance on top of it too.
Yeah, and you're not paying that up front. That's going to be added on to.
Get paid on top front?
No, that's added. You're going to pay like a $150 per door, but actually that gets added to the mortgage as well. That premium that you pay, it gets added to the mortgage. But what you do pay, which is the biggest expense, is the mortgage broker fee, and the lawyer fees are more expensive on the commercial side. So it ends up being around 5% of the purchase price. Good to budget for that.
Because I think on the residential side, we have to pay that up front, right? If you do CMHC, do you know? If you do CMHC on the residential side, don't you have to pay
the premium?
Like a premium up front?
I don't think you pay that up front. I think it gets added to your mortgage.
Okay, clearly I've never done CMHC, as you can tell.
I've never done it on the residential side.
No, neither have I. I mean, actually, I've never done it at all, either side. But good to know. I always thought you actually had to pay that premium up front. So that's,
no,
it's good to know. So I feel like I don't know where the downside is on CMHC then, because I always thought like that, like calculating those extra costs too for CMHC. But if there aren't, and they just kind of lump it into the mortgage, it's obviously 10 times easier, because obviously your monthly payments is a lot lower than having to pay like a 1% upfront fee on top of like all the extras, right?
Yeah, exactly. No, if you had to come up with that upfront, that would, yeah, be a lot more expensive. Like, you do have to pay it off eventually. You eventually are paying for it.
But that's what I'm thinking. It's easier though once a month, right? Compared to like the upfront.
Yes, exactly. Yeah.
Awesome. So if people want to reach you and contact you, where can they get a hold of you?
The best on Instagram is, my handle is @Brei Properties, so BREI Properties, or my website is brei.ca, or you can even send me an email at zorya@brei.ca.
Awesome. Thanks for coming on. I'm so excited to have you on at the networking event. I've heard her speak on the CMHC. She spoke on, I think, was it like a month and a half ago. And so it's a lot of great information. And I'm sure you're gonna probably even provide even more different information in this one, because it's a lot longer. You have more time to get us in there really deep. So I'm kind of excited to hear it all.
Yeah.
So thanks so much for coming on. It was a pleasure to have you, and we'll see you in, I believe it's in February 8th, their networking events.
Yeah. Oh, well, thanks so much for having me on.
Awesome. We'll see everyone in the next Yeah, we'll see everyone in the next episode. Bye, everyone. Bye, Zorya.
Bye.